2022 continues to be a rough year for both stocks and bonds, analyzing the different directions the economy and the stock market seem to be taking in this week's Fastest 4 Minutes in Finance. Well, hello again, I'm Scott Inman. At the time of this recording, 2022 has been one of the worst starts to a year ever for a diversified portfolio. The S&P 500 is down 12% year to date. At the same time, though, the overall economy is currently still running pretty strong. It's true, inflation is running at a 40-year high, but that hasn't really slowed consumer spending, and corporations are still raking in revenue. Most of the earnings season reports this month are signaling strong year-over-year growth, and we believe the market always returns to fundamentals in the long term. But in the short term, stocks seem to be sour to good economic news. Question is why? Well, there are lots of reasons, but the consensus number one reason is rising interest rates. Check this out. Brad McMillan, the Chief Investment Officer for Commonwealth Financial Network, reminds us that the market tends to move a different direction than the economy when interest rates are not steady. Even though it was expected, we've seen rates rise at one of the fastest paces in decades over the past couple of months, and they are expected to go even higher the rest of the year. So McMillan says this causes investors to take a different view of the prices they are willing to pay for a corporation's good earnings. For instance, between 2016 and 2019, investors were willing to buy at 16 to 18 times the next year's expected earnings for the S&P 500. After the pandemic began, when interest rates were cut, that jumped to 20 to 22 times earnings. And then this year, as rates rose, valuations dropped to between 18 and 20 times earnings. So it's also good to have a historical perspective here. It's not uncommon in any given year to experience a pullback, similar to this. In fact, since 1980, the average year has corrected 14% off its highs. So where do we go from here? Well, every year has its own unique challenges and opportunities, but this is a midterm election year, and those tend to be rough, at least for most of the year. Taking a look at a chart from LPL Research, the intra-year pullback during a midterm election year has been 10% or worse in 13 of 19 years, going all the way back to 1950. And we've experienced a double-digit drawback in 4 of the past 5 midterm years, including this one. The other thing to note from this chart is that the low is not usually reached until later in the year. On average, it's mid-August before that happens. That could suggest that the volatility of 2022 will continue. On the upside, though, once that low is reached, the next 12 months are higher. The average gains a year out from the midterm low are more than 32%. This chart backs up what we say all the time on the Fastest 4: equities are long-term investments. And it's never a good idea to make an emotional decision about your investments when the market is down like it is right now. Thanks for listening.